Today is 18th of March 2025. We will discuss about financial statement, and we should know about why financial statement come out, because it is because of separation of management and governments. Owners can't really know about the company. So there comes balance sheet, which is statement of financial position, and statement of cash flow, and income statement, which is financial performance. For income statement, you should remember that there's revenue and there's net income. It straightly relate each other by minus equals to something and gross, minus equals to something equals gross income, and minus equals to something equals to earnings before tax, and it becomes net income. If it becomes net income, you can do analysis like net income divided by holder shares, number of shares, which is EPS. I will talk it later. For balance sheet, which is the important formula, is asset equals to liability plus stockholders' equity. And for the current assets expected to be turned into cash into the next year's account receivable versus preferred and deferred income, which is what is different, is what I'm asking. And for the long-term asset, there's net property, plant, and equipment, which is related with depreciation, and goodwill and intangible asset, which is related amortization, which is depreciation of intangible asset. Intangible asset example is employee, brand name, and trademark. Other long-term asset can be investment in long-term securities. For liabilities, current liabilities is due to the paid within the next year. My question is the difference between account payable and preferred or delayed payment. And net working capital is important, which is current asset minus current liabilities. This is definition, but there has more meanings. But my question is, what exactly is the difference? Or what is the meaning of it? For stockholders' equity, there's book value of equity and there's market value of equity. Book value of equity, you can find it in financial statement of balance sheet. For market value of equity, you can define it by market price per share multiplied by number of shares outstanding, market capitalization, which is bigger than zero, which is positive real number. For the ratio in between book value of equity and market value of equity is PBR, and you can analyze PBR, analyze growth, whether it is growth stock or value stock by PBR. For example, Ford in 2017, it has big net income and revenue than Tesla, but Tesla has more higher market value because Ford is more, which has low PBR rate, which is, we can say, value stock, and Tesla is fast growth stock. These days, Palantir has 40 PBR, so we can say they are growth stock. And this is the logic of income statement. Revenue minus equals to gross profit minus equals to operating expense equals to operating income minus plus equal to this will become EBIT. EBIT minus plus equal will be plus pre-tax. Then from pre-tax income minus tax, then it will be net income. So with this net income, we can analyze EPS and we can get diluted EPS, which is add convertible securities like stock options and convertible bonds as shares outstanding. And for statement of cash flow, we should deduct and add something not really spent in income statement. For example, in operating activity, depreciation, we should add them back amount of depreciation from income statement because we didn't really spend it. For account receivable, we should supposed to receive it, but we did not receive it yet. So we should deduct the increase. Account payable opposite way. We should increase it because we should pay it, but we didn't pay it yet. So we should increase in cash flow situation. For inventories, we should deduct it because in balance sheet, we already increased it as asset, but not really we earn the money and get the cash yet. For investment activity situation, there can be capital expenditure or marketable securities. For financing activity, there can be payment of dividends, such as retained earning equals to net income minus dividend, or change in borrowing. For the stockholders' equity, change in stockholders' equity equals to retained earning plus net sale of stock, or equals to net income minus dividend plus sales of stock minus repurchase of stock. For financial statement analysis, you can compare the firm with itself over the time. You can do time value analysis, such as real growth, you can check the income statement, two income statement with different time. You can do present value analysis, and you can check real growth rate or interest rate, reflected growth rate. Or what you can do is, in engineering economy, we say it 13 analysis, which is with investment, in initial investment, we can make scenario of income statement for 3 days or n days. Then we can get retained earning calculation. Based on it, we can do cash flow calculation. So is it really, are we earning the money or are we losing the money? And valuation ratio, we already talked about PER and PBR. PER, we can interpret as two ways. One way is price equals to EPS multiplied PER. So we can think of every value that affects to price is in PER, economic variables and industry variable, company level variable, and team level, personal level variable. And for operating returns related ROE things, leverage ratio, invest coverage ratio, which is if your net income can't afford to pay back each interest, then maybe you should start your business. And working capital ratio. And with these things, you can compare the firms with other similar company. So what I talked today, the important thing is income statement. Is this logic is important. Revenue minus equals to, and you can make it to net income. For balance sheet, asset equals to liability plus equity. So there can be for each item there's amortization and these things needed. For statement of cash flow from net income, you should deduct or increase the thing that is actually not reflected. Thank you very much.